What if everything you believe about trading is wrong? What if the reason you haven't achieved consistent profits isn't because you lack intelligence or capital or the perfect strategy? What if the real reason is something far more subtle, far more dangerous, and far more personal? Your habits, not your indicators, not your broker, not the market manipulation stories you hear every day. Because trading is not a technical game, it is a behavioral game. The market does not reward excitement. It does not reward aggression. It does not reward aggression. It does not reward hope. It rewards discipline. It rewards discipline. It rewards discipline. It rewards discipline. And those things are built through habits. Small actions repeated daily. Most traders enter the market focused on profit. They calculate how much they could make in a week, in a month, in a year. They imagine financial freedom. They imagine quitting their job. They imagine success. But very few traders ask themselves a more powerful question. Who do I need to become to handle consistent profitability? Because here is the truth no one talks about. If you gave an undisciplined trader a profitable system, they would still lose money. Why? Because they would overtrade it. They would increase lot sizes emotionally. They would ignore stop-loss rules. They would sabotage it with fear and greed. The strategy is rarely the problem. The trader is, and that's actually good news, because if the problem is you, the solution is also you. You don't need secret indicators. You need structured behavior. You need routines that protect you from yourself. You need habits that turn emotional reactions into calculated decisions. Professional traders are not superheroes. They simply built habits that protect their capital, protect their psychology, and protect their long-term edge. They learned how to think in probabilities. They learned how to accept losses without emotional collapse. They learned how to focus on process instead of daily profits. And when you build those habits, something extraordinary happens. You stop reacting. You start operating. You stop gambling. You start managing risk. You stop chasing money. You start building consistency. And consistency is what creates life-changing results. Today, I'm going to walk you through 7 trading habits that will not just improve your account, they will transform your discipline. They will strengthen your emotional intelligence. They will build mental toughness. They will reshape the way you approach risk, money, and pressure. Because trading is more than charts. It is personal development under financial pressure. And if you master these 7 habits, you won't just change your trading. You will change your life. Let's begin. The biggest lie beginners believe is this: if I can just catch one big trade, everything will change. That mindset destroys accounts. Because trading is not about catching one big move, it is about surviving long enough for probability to work in your favor. Capital is your lifeline. Without capital, you are out of the game. And most traders lose their capital not because their strategy is terrible, but because their risk management is reckless. They risk 5%, 10%, sometimes even 20% of their account on a single trade. Why? Because they want fast results, because they are impatient, because they think confidence means increasing lot size. But confidence without discipline is gambling. Professional traders think differently. Before they think about profit, they think about protection. Before they calculate gains, they calculate risk. They ask, if this trade fails, how much damage does it cause? How much damage does it cause? That question alone changes everything. If you risk only 1% per trade, you can survive 20 losses and still have most of your capital intact. But if you risk 10% per trade, 5 bad trades can emotionally and financially destroy you. And here is something powerful: losses are statistically normal. Even the best trading systems lose 30% to 50% of the time. So if losses are guaranteed in the long run, why would you risk large portions of your capital? Capital preservation creates emotional stability. When you know that no single trade can destroy you, your stress level drops dramatically. You stop staring at every candle. You stop panicking at small drawdowns. You stop moving stop losses out of fear because your risk is controlled. This habit also forces patience. When risk is limited, you stop looking for any trade. You start looking for high-quality setups. You become selective, and selectiveness increases accuracy. Think about professional fund managers. They don't risk everything on one decision. They diversify. They calculate. They protect downside first. Because survival is success. And in trading, survival leads to consistency. When you build this habit, you begin thinking long term. You stop asking, how much can I make today? You start asking, how do I protect my ability to trade next month? That shift in mindset is maturity. And maturity in trading leads to stability. Stability leads to confidence. Confidence leads to growth. Capital preservation is not about being afraid. It is about being strategic. It is about respecting probability. It is about understanding that one trade does not define you. When you master this habit, you become calmer under pressure. And that calmness is priceless. Because trading is not won by the most aggressive person. It is won by the most controlled person. Protect your capital first. Profit is a byproduct of survival. If there is one habit that separates struggling traders from consistent professionals, it is this. They never trade without a written plan, not a mental plan, not something they remember, not something they kind of follow. A written plan. Because memory bends under pressure, but written rules do not. Most traders open charts and start reacting. They see a candle move fast, and they jump in. They see a breakout forming, and they anticipate it. They see others making money, and they feel urgency. This is emotional trading. And emotional trading is unpredictable. A professional trader, on the other hand, already knows exactly what they are looking for before the market opens. They know buyback what market conditions qualify for trading fiat, what time frames they operate on, VECI, what exact setup triggers an entry, VE, where their stop loss goes, fiat, what their minimum risk to reward ratio must be, ECU. When they stop trading for the day, this removes guesswork. When you don't have a written plan, every candle feels like an opportunity. Every move feels urgent. You begin convincing yourself that this looks good enough. But good enough destroys accounts. But good enough destroys accounts. A written trading plan builds discipline automatically. Because now the question is no longer, and should I take this trade? The question becomes, does this match my system? That is a powerful psychological shift. You are no longer emotional, you are analytical. And analysis reduces stress. Stress comes from uncertainty. When you don't know what you're doing, every tick of the market creates anxiety. But when your plan is clear, the market becomes simple. Either your setup appears, or it doesn't. If it doesn't, you wait. This habit also protects you from revenge trading. When you lose a trade without a plan, your ego reacts. You want to win it back. You increase lot size. You enter without confirmation. But when you follow a written plan, losses feel different. They feel controlled. They feel expected, because you understand that no system wins 100% of the time. Having a plan also builds confidence over time. Why? Because consistency creates clarity. If you follow the same rules over 100 trades, you can measure performance accurately. You can refine it. You can improve it. But if you constantly change your rules based on emotion, you never know what actually works. A trading plan turns gambling into business, and that shift changes your entire mindset. You stop looking for excitement. You start looking for execution. You stop chasing movement. You start waiting for confirmation. And here is the deeper transformation. This habit spills into your life. You begin planning finances. You begin structuring goals. You stop reacting impulsively in decisions. Because structure creates control, and control creates confidence. Without a written plan, you are reacting to the market. With a written plan, you are reacting to the market. And operators survive. Reactors struggle. If you want consistency in trading, you must remove decision-making from emotional moments. Write the rules. Follow the rules. Review the rules, but never trade without them. There is another layer to trading with a written plan that most traders ignore, and that layer is accountability. When your rules are written, breaking them becomes obvious. You cannot lie to yourself. If your plan clearly says, only trade London session, and you take a random trade during low volume hours, you know you broke the rule. If your plan says, minimum 1-3 risk to reward, and you enter a 1-1 trade because you feel impatient, you know you compromised. This level of clarity forces self-respect, because every time you follow your rules, even if the trade loses, you build internal confidence. And every time you break your rules, even if the trade wins, you damage your discipline. Winning with bad behavior is dangerous because it reinforces the wrong habit. Many traders destroy their future success because they got rewarded for breaking rules. They enter impulsively, it wins. They increase risk emotionally, it wins. They skip confirmation, it wins. And now they believe discipline is optional until the market corrects them. And when it does, it corrects them aggressively. A written plan prevents this cycle. A written plan prevents this cycle. It keeps you grounded. It keeps you consistent. It reminds you that trading is not about excitement. It is about execution. Another powerful benefit of a written plan is emotional detachment. When every NG is predefined, you stop personalizing trades. You are not right or wrong. You are simply executing a probability model. That shift is huge. Instead of saying, I lost, you begin saying, the setup lost. Instead of science's ovations, the probability didn't play out this time. This separation protects your ego, and when ego is protected, emotional stability improves. Professional traders operate like engineers. They build a system, they test it, they refine it, they execute it. There is no drama. There is no panic. There is no impulsive behavior. Just structure. And structure creates peace. Without structure, trading feels chaotic. With structure, trading feels controlled, even during volatility. Even during losses, a written plan also prevents strategy hopping. Most traders jump from one system to another. After a few losses, they don't give anything enough time to prove itself. But when you commit to a written plan and track it over 100 trades, you finally see real data. You see your average risk to reward. You see your drawdowns, and now improvement becomes mathematical, not emotional. This is how professionals grow, not by chasing the next indicator, but by mastering execution. When you trade with a written plan, you are not hoping. You are operating, and operators survive long enough to win. If risk management protects your money, and a written plan protects your structure, then emotional control protects your future. Because here is the brutal truth. Most traders do not lose because of bad analysis. They lose because of emotional reactions: fear, greed, impatience, ego, overconfidence, revenge. These emotions quietly destroy accounts every single day. And the dangerous part, most traders don't even realize it's happening. Let's break it down. Fear causes you to close winning trades too early. You see a little profit. The market pulls back slightly. Your heart rate increases. You close the trade. Later, price hits your full target. You didn't lose because of strategy. You lost because of fear. Now let's talk about greed. Greed convinces you to hold beyond your target. Your plan says take profit at 1.3, but price is moving strongly. You think, maybe I can get more. You remove the take profit. Price reverses. Now your winner becomes a loser. Again, not a strategy issue, an emotional issue. Impatience is another silent killer. You sit in front of charts for hours, nothing is happening. You feel unproductive. You feel restless. So you take a trade that almost fits your rules, almost is expensive. Ego shows up after wins. You hit 2 good trades. Confidence rises. You increase lot size. You loosen rules. You feel invincible. Then the market humbles you. Revenge trading happens after losses. You feel frustrated. You feel challenged. You want your money back immediately. So you enter again without confirmation. Now the loss doubles. This cycle repeats for most traders, and until you break it, consistency is impossible. Emotional control is not about becoming emotionless. It is about awareness and discipline. Professionals still feel fear. They still feel excitement. They still feel frustration. The difference: they don't act on it. They have rules that protect them from themselves. For example, after 2 consecutive losses, stop trading for the day. After a big win, take a mandatory break. These rules create boundaries, and boundaries create stability. Another powerful habit is emotional journaling. Before entering a trade, ask yourself, how do I feel right now? Are you calm? Are you tired? Are you stressed from something outside trading decisions? A disciplined trader does not trade when emotionally unstable. They protect their mental capital the same way they protect financial capital. Here is something important. You cannot eliminate emotion, but you can train response. When price moves against you, your heart rate may increase. That's normal, but instead of reacting, you breathe. You remind yourself, the risk was predefined, this loss was already accepted. That internal dialogue builds strength. Over time, your emotional swings reduce. Losses stop feeling personal. Wins stop feeling euphoric. You operate in neutrality, and neutrality is powerful. Because when you are neutral, you think clearly. When you think clearly, you execute correctly. And correct execution over time leads to profitability. This habit extends far beyond trading. When you learn to control emotion with money on the line, you become calmer in business negotiations. You become steadier in personal conflicts. You become stronger under pressure because trading trains your nervous system. It forces you to face fear repeatedly. And if you learn to manage it, you build resilience. Resilience builds confidence. Confidence builds consistency. And consistency builds wealth. Master your emotions, or your emotions will master your account. One of the most destructive mindsets in trading is waking up every morning thinking, I need to make money today. That sentence alone creates pressure. And pressure creates poor decisions. Because when your goal is daily profit, you start forcing outcomes. You take trades that are not fully aligned with your system. You increase risk to hit your target. You stay in the market longer than necessary. You measure your self-worth based on green or red numbers. This is emotional attachment to outcome, and outcome obsession destroys consistency. Professional traders think differently. Their daily goal is not profit. It is flawless execution. They measure success by one simple question. Did I follow my rules perfectly? If the answer is yes, it was a good day, even if the trade lost. Let that sink in. A losing day can still be a successful day. Why? Because trading is a probability game. No system wins 100% of the time. Even a strong 60% win rate means 40 out of 100 trades will lose. If you judge yourself based on single outcomes, you will constantly feel unstable. One win, you feel powerful. One loss, you feel defeated. That emotional roller coaster makes long-term growth impossible. When you focus on process, everything changes. Instead of chasing money, you chase discipline. Instead of chasing results, you chase consistency. And here is the powerful truth. When process is consistent, profits become inevitable over time. Think about a casino. A casino does not panic after a losing night. They don't change their games. They don't increase risk emotionally. They trust mathematics. They trust volume. They trust probability. You must do the same. When you shift your mindset from I must make money today to I must execute my system correctly today, stress decreases dramatically because you can control the market, but you can control your behavior. And behavior is the only thing that truly matters. Another major benefit of process focus is emotional stability. If you lose a trade but followed your system perfectly, you remain calm. If you win a trade but broke rules, you feel cautious. Not proud. That is maturity. Many traders celebrate rule-breaking wins. That is dangerous, because bad habits rewarded once will be repeated. And eventually, the market punishes them. Process-focused traders understand long-term performance. They track results over 50 trades, over 100 trades, over months, not days. They zoom out, and when you zoom out, individual losses become insignificant. You stop reacting emotionally to every candle. You stop checking your P&L every 5 minutes. You start thinking like a business owner. A business owner does not evaluate success based on one sale. They evaluate quarterly performance. Trading must be treated the same way. Another important element here is detachment. When you focus on process, you detach from the need to be right. You stop needing validation from the market. You stop trading to prove something. You simply execute. And execution builds mastery. Over time, this habit changes your identity. You stop seeing yourself as someone trying to make money. You start seeing yourself as someone building a system. That identity shift is powerful because identity drives behavior, and behavior drives results. This habit also reduces burnout. When every day is about making money, trading becomes exhausting. But when every day is about clean execution, trading becomes structured, calm, professional, and sustainable. In the long run, traders who obsess over daily profit quit. Traders who obsess over process grow because profit is an outcome. Process is a skill, and skills compound. Master the process. Respect the process. Trust the process. And over time, the profits follow. If you are not journaling your trades, you are guessing your growth. And guessing does not build mastery. One of the biggest differences between average traders and elite traders is this: professionals track everything. Amateurs rely on memory, and memory is emotional. After a losing streak, your brain tells you, my strategy doesn't work. After a winning streak, your brain tells you, I've mastered this. Without data, you cannot see reality clearly. A trading journal forces truth. After every trade, you should document why you entered by P, whether the setup matched your written plan IP, your exact risk percentage, your emotional state before entry, your emotional state during the trade B, whether you followed rules completely. The final result, IP, lessons learned. This may sound simple, but this habit transforms your trading. Why? Because patterns reveal themselves over time. Maybe you lose more trades when trading late at night. Maybe you break rules after 2 consecutive wins. Maybe you overtrade on low volatility days. Maybe you hesitate after losses and miss good setups. Without journaling, these behavioral leaks remain invisible. And invisible weaknesses are the most dangerous. Professional traders treat trading like athletes treat performance. Athletes review game footage. They study mistakes. They refine techniques. They do not rely on how it felt. They rely on recorded evidence. Your journal is your footage. It exposes your habits, and sometimes that exposure is uncomfortable. You may discover that most of your losses were not strategy failures. They were discipline failures. That realization can hurt, but it is powerful because once you see the problem clearly, you can fix it. Another benefit of journaling is emotional awareness. When you consistently write down how you felt during trades, you begin recognizing emotional triggers. You start noticing, I tend to overtrade when I'm bored. ID, increase risk after big wins. I hesitate when I feel uncertain. That awareness creates control, and control creates stability. Over time, your journal becomes a blueprint for improvement. You can calculate settings BANG, your win rate. VH, your average risk to reward ratio. VH, your average risk to reward ratio. Your maximum drawdown. BH, your best performing setups. BH, your worst performing conditions. Now improvement becomes mathematical, not emotional. Instead of saying, I think I'm improving, you can say, my win rate improved from 48% to 56%. That clarity builds confidence. Confidence built on data is stronger than confidence built on emotion. There is another powerful reason journaling matters. It reduces ego. When everything is written down, you cannot lie to yourself. You cannot blame the market for every loss. You see the truth on paper, and once ego decreases, growth accelerates. Because growth requires honesty. Journaling also reinforces discipline. When you know you must document every trade, you think twice before breaking rules. You ask yourself, do I want to write down that I broke my system again? That small psychological pressure increases accountability, and accountability builds professionalism. Most traders want freedom, but freedom comes from structure, and structure comes from tracking behavior. This habit turns random trading into structured development. It transforms you from someone reacting to markets into someone refining a craft. Over months and years, that refinement compounds. Your mistakes decrease, your awareness increases, your emotional reactions shrink, and your consistency improves. If you want to treat trading like a business, then act like a business. Track performance, analyze data, refine execution, journal relentlessly, because growth without measurement is illusion, and mastery without self-awareness is impossible. Overtrading is one of the fastest ways to destroy a trading account. And the dangerous part is most traders don't even realize they are doing it. They believe they are being productive. They believe more trades equal more opportunity. They believe staying glued to charts increases their chances of profit. But in reality, overtrading is often driven by emotion, not strategy. Let's break this down. When you sit in front of charts for hours, your brain becomes overstimulated. You start seeing setups that aren't truly there. You convince yourself that something almost fits your rules. Almost is expensive. High-quality trades are usually obvious. They meet all your conditions clearly. They don't require mental gymnastics to justify. But when you are bored or impatient, your standards drop. You begin trading for activity, not for precision. That is overtrading, and overtrading usually comes from three main psychological triggers: boredom, impatience, and the need to feel in control. Boredom is powerful. Trading often involves waiting, sometimes for hours, sometimes for days, and waiting feels unproductive. So you take a trade just to feel engaged. Impatience pushes you to enter early. Your setup is forming, but confirmation isn't complete. You don't want to miss it, so you jump in, often too soon. The need for control is even more dangerous. After a loss, you want to take another trade immediately. You feel like doing something gives you power, but that action is emotional, not strategic. Professional traders understand something critical. The market does not pay you for effort. It pays you for precision. Some of the most profitable traders take only a few trades per week. But those trades meet strict criteria. They don't chase movement. They wait for alignment. Limiting trades protects more than your money. It protects your mental capital. Mental capital is your clarity, your decision-making ability, your emotional stability. Every trade consumes mental energy. And when that energy runs low, decision quality drops. This is called decision fatigue. The more decisions you make in a day, the worse they become. If you take 10 trades, the 10th decision is rarely as sharp as the first. Professionals solve this by setting strict limits. For example, maximum 3 trades per day. Stop trading after 2 consecutive losses. Only trade during specific hours. When limits exist, discipline improves, and discipline increases performance. Another important benefit of limiting trades is emotional balance. When you trade less, you care less about individual outcomes. You don't feel constant pressure. You don't feel constantly in battle. Your nervous system remains calm, and calm decision-making is profitable decision-making. Here is something powerful decision-making. Here is something powerful decision-making. Activity feels productive. Selectivity feels slow. But selectivity feels slow. Over time, this habit changes your identity. You stop being someone who is constantly chasing. You become someone who waits confidently. You trust your system, you trust timing. You understand that opportunities are infinite. But capital is not. This mindset reduces fear of missing out. It reduces impulsive entries. It reduces emotional exhaustion. And when emotional exhaustion decreases, consistency increases. Overtrading usually comes from insecurity, from the belief that you must always be doing something. But professionals know that sometimes the best trade is no trade. When you eliminate overtrading, you protect your capital, your focus, your energy, your psychology, and all of those together create long-term sustainability. Trade less, think more, wait longer, execute better, because in trading, precision beats activity every single time. Most traders are willing to deposit thousands of dollars into a broker account, but they hesitate to invest a fraction of that into their own development. That is backwards thinking, because your trading income will never exceed your level of personal growth for long. Let that sink in. You can get lucky. You can hit a few good trades. You can even double an account temporarily. But if your discipline, psychology, and knowledge are not strong enough to handle growth, you will lose it. The market exposes weaknesses quickly. If you are impatient, the market will show it. If you are greedy, the market will show it. If you are greedy, the market will show it. Trading is like a mirror. It reflects your character under financial pressure. That is why investing in yourself is the ultimate trading habit. And this investment is not only about buying courses. It is about building internal strength. Read books on behavioral psychology. Study how the human brain reacts to risk. Understand cognitive biases like loss aversion. confirmation bias, and overconfidence bias, because these biases silently affect every decision you make in the market. Work on your physical health. Your sleep quality affects reaction time. Your diet affects focus. Your exercise routine affects emotional regulation. A tired trader makes impulsive decisions. A disciplined body supports a disciplined mind. Build routines outside of trading. Wake up at consistent times. Set clear daily goals. Train yourself to finish what you start. Because discipline in small areas transfers to discipline in trading. Seek mentorship when possible. Not because someone will give you secret signals, but because experience shortens learning curves. Learning from someone who has already survived the market's harsh lessons can save you years of mistakes. Another powerful area of self-investment is emotional training. Meditation improves awareness. Breathing exercises improve control during volatility. Journaling improves clarity. These practices strengthen your nervous system, and trading is a nervous system test. The stronger your internal foundation, the more stable your external performance. There is something else most traders misunderstand. They think trading is about making money. But trading is about becoming the type of person who can handle money. Handling growth requires emotional maturity. If your account doubles, can you stay calm? If your account drops 10%, can you remain disciplined? If not, the issue is not strategy, it is personal development. When you invest in yourself, your confidence becomes grounded, not arrogant, not fragile, but stable. And stable confidence is powerful because it allows you to execute without hesitation. It allows you to accept losses without collapse. It allows you to grow without losing control. This habit changes your life beyond trading. You become more focused, more disciplined, more patient, more strategic. You think long-term. You manage risk in business decisions. You avoid emotional reactions in personal conflicts. Because trading forces you to confront your weaknesses. And if you choose to improve instead of blame the market, you evolve. Most traders look for external solutions, new indicators, new strategies, new time frames. But the real edge is internal. It is mindset. It is emotional control. It is discipline. And those are built through continuous self-investment. The market rewards maturity. It rewards patience. It rewards structure. And maturity does not come from charts. It comes from growth. If you want life-changing results in trading, become life-changing in discipline. Invest in yourself. Because when you grow, your trading grows. And when your trading grows, your opportunities expand. This is the ultimate habit because it turns trading into transformation. If you master these 7 habits, you will not just become a better trader. You will become a stronger individual. You will think in probabilities instead of emotions. You will protect capital instead of chasing excitement. You will follow structure instead of reacting impulsively. You will focus on process instead of daily profit. You will track your behavior instead of blaming the market. You will trade less, but trade better. And most importantly, you will invest in yourself. Because trading is not a shortcut to easy money. It is a test of discipline, a test of patience, a test of emotional strength. The market does not care about your dreams. It does not care about your goals. It only responds to behavior. And behavior is built through habits. Small daily decisions, repeated, refined, respected, expected. When you change your habits, you change your performance. When you change your performance, you change your confidence. You change your identity. And when your identity evolves, your life follows. Master your habits, master your discipline, master yourself, and the profits will follow forever.